Welcome to today's Explainer. We are diving into a fascinating, massive, and honestly often misunderstood sector of the global economy, Islamic finance. We are going to unpack the unique mechanics of this entirely asset-backed ecosystem. And get this, it's a nearly $6 trillion industry. Yes, you heard that right, almost $6 trillion. It is huge, so let's dive right into this. Here is our agenda for today. 1. Banking without interest. 2. How Islamic banks profit. 3. Leasing and joint ownership. 4. Rules of Sharia investing. 5. The Islamic fintech boom. And 6. Modern banking challenges.
Now, I want to start off with a massive question. It's one that puzzles almost every conventional investor when they first hear about this. How exactly does a multi-trillion-dollar banking system survive and even thrive without charging a single cent of interest? I mean, it sounds like a complete paradox, right? Let's figure it out.
Section 1. Banking without interest. The core constraint.
Look at the foundational difference here. In the conventional finance world we're mostly used to, money itself is treated basically like a commodity. Banks lend you money and they charge compounding interests on those loans. But in Islamic finance, the system is entirely asset-backed and built on risk sharing. Money is seen just as a medium of exchange, definitely not a commodity to be rented out. And most importantly, interest is strictly 100% prohibited.
This brings us to a really crucial term you absolutely need to know: riba. Riba is the forbidden practice of charging or paying interest. Because of this extremely strict prohibition, Islamic banks literally cannot just lend you cash and charge you 5% a year. They just can't do it. Instead, they have to use alternative, real-world structures, and these structures have to be based on actual trade, tangible assets, and real ownership.
Moving on to Section 2, How Islamic Banks Profit, the Mechanics of Murabah. Okay, so if they can't charge a dime of interest, how on earth do these banks keep the lights on? Well, the answer is Murabah. This is the single most popular financing technique used by Islamic banks globally. By definition, Murabah is a cost-plus financing arrangement. Basically, what happens is a commodity is sold to a client for a completely disclosed original cost plus a mutually agreed-upon profit margin. Think of it as a pure sale, not a loan. Let's break this down with a real-world, step-by-step example to make it crystal clear, because it's actually pretty brilliant. Step 1. Let's say a business client identifies a piece of equipment they desperately need for production, and it's worth $25,000. Step 2. The Islamic bank steps in, actually purchases that equipment directly from the supplier, and takes real legal ownership of it. Step 3. The bank then turns around and sells that exact piece of equipment to the client for $28,000. And finally, Step 4. The client pays that $28,000 back to the bank in deferred installments over time.
Now, here is the absolute key distinction you need to take away from this. Yes, the bank makes a $3,000 return, but that $3,000 is a fully disclosed sale margin based on the real transfer of a physical asset. It is absolutely not an interest charge on a cash loan. The lawful profit here is inextricably connected to the bank actually owning the asset, even if it's just for a brief moment, and taking on the very real risk of that ownership. In this system, no risk means no reward.
Section 3. Leasing and joint ownership, ijara and musharakah.
First up here is ijara. You can basically think of this as the Islamic equivalent of an operating lease. It is a rental arrangement where a durable asset, like say a car or heavy factory machinery, is leased out to a customer against a very specific rental payment plan for a fixed period of time. The bank strictly retains ownership of the asset and is entirely responsible for major maintenance, while the customer simply pays for the right to use it.
Then we have musharaka, which literally translates to partnership. This is a scenario where two or more parties share profits based on a mutual agreement. But here is the critical rule. They must share any losses exactly in proportion to the capital they invested. So there is a deep structural reliance on genuine, proportionate risk sharing between everyone involved.
And this concept builds into a super common, incredibly useful product for homebuyers known as diminishing musharaka. In this model, the bank and the customer jointly own an asset, like a house. Over time, the customer pays rent for the bank's share of the property, but they also buy equity units from the bank. Gradually, step by step, the bank sells its share to the customer until the customer owns the house 100% outright. It is a completely risk-sharing path to homeownership with zero traditional mortgage interest.
All right, Section 4, Rules of Sharia Investing, the screening process.
So if you want to invest the Islamic way, you first have to pass what's called a business activity screen. You absolutely cannot invest in companies involved in things like pornography, tobacco, conventional interest-based financials, or the trading of gold and silver as cash on deferred terms. For a stock to be deemed compliant, revenue from any of those non-permissible activities must remain strictly under 5% of the company's total income.
But actually, passing that business screen isn't enough. Not even close. You also have to pass a financial ratio screen. And that brings us to a massive golden rule, 33%.
Think of this as a strict limit on financial toxicity, because even if a company makes totally lawful products, it cannot be drowning in debt or interest-bearing cash. A compliant company's total debt, its cash, and interest-bearing securities, and its account receivables, when divided by its average market capitalization, must each remain strictly under 33%. This whole idea is based on the Islamic jurisprudential principle of minimal versus large. It basically ensures that interest-bearing elements don't completely overwhelm the actual lawful underlying business in your portfolio.
Moving on to Section 5, the Islamic FinTech Boom, Global Scaling. Just look at this. The 2025-26 Global Islamic FinTech Database reveals a truly massive variety and deep technological integration. This isn't just some niche, theoretical concept we're talking about. It is a rapidly expanding, highly modernized global industry, with startups successfully scaling literally all over the world.
And this booming ecosystem spans way beyond just your basic checking accounts. We are seeing absolutely massive growth in wealth management, crowdfunding, digital assets, and peer-to-peer alternative finance. Islamic fintech is tackling incredibly diverse verticals right now, bringing seamless, Sharia-compliant options right to your smartphone. It's a real game changer.
And finally, Section 6, Modern Banking Challenges, Liquidity Risk. Now look, it's not all smooth sailing, because Islamic banks cannot rely on conventional overnight interbank loans or interest-bearing central bank reserves simply because those mechanisms involve riba. They face persistent structural liquidity risks. As a result, they often have to hold really high balances of idle cash just to be perfectly safe. It is a real structural friction caused by their strict ethical constraints, which essentially locks these banks out of the traditional central bank safety nets that conventional banks rely on every single day.
I want to end this explainer with a really powerful quote from a recent study in the Suhuf Journal. It simply says, "Risk sharing versus risk shifting, a comparative study of Islamic banks." This profound thought perfectly captures the fundamental difference at the heart of this entire system. You see, conventional finance very often shifts risk entirely onto the borrower, while Islamic finance strives to genuinely share that risk between the capital provider and the entrepreneur. So what do you think? Does this risk-sharing model hold the key to a more stable global economy? It is a trillion-dollar question, and one definitely worth pondering.